Good day, good talks. My name is Carden Madzokere, and welcome to lesson 1.1 on international trade. I've realized that I seem to neglect this topic. I have so many videos on secular flows, so many on business cycles, but not as much on international trade. And so many learners are requesting that I treat these graphs because somehow they say they are confusing. So let's have a look. So this one says study the graph below and answer the questions that follow. So as we study the graph, what do we see? We see exchange rate. Yes, we know what this is. The rate at which one currency can be traded for another. So in this case is the rate at which rands are traded for dollars, or the other way around, dollars traded for rands. Now this is the exchange rate. Okay, so I may start with the initial equilibrium or point of equilibrium. You see we have a demand curve there, we have a supply curve there. So they intersect at point E, and so the exchange rate is $1 is equivalent to 11 rands. Now, that said, it simply means if you have $1, it's as much as saying you have 11 rands. Okay. Now, things can happen to that will cause a change in the value of this. So it can happen that supply decreases or supply increases. It can also happen that demand increases and demand decreases. Now, there are so many factors that contribute to this. Let me address what we see here. This is a decrease in supply for US dollars, right? Because you see here it's a market for US dollars. Now, what can cause a decrease in supply for dollars? Basically, this is saying if Americans do not come on the foreign exchange market and supply their dollars in exchange for rands, a reason might be that they are traveling less to South Africa. Many factors can contribute to that. Maybe there's war in South Africa. Maybe there's something happening in South Africa. Maybe there's an outbreak. Anything can cause a decrease in supply for dollars. Like on the foreign exchange market, less United States dollars are supplied. And when those dollars are supplied, it means the rand is being demanded, basically. And this is demand for dollars. So what is happening here is nothing has changed in terms of demand for dollars, and demand for dollars happen when anyone in possession with the South African rand goes on the foreign exchange market and say, I want dollars. Okay, but what we see changing here is people going on the foreign exchange market saying we want rands, here are dollars. So they are supplying their dollars. So a decrease in that, like when Americans come less to South Africa, so when there's a decrease in supply for dollars and nothing changing in terms of demand, what we see is, what I mean is quantity demanded, like the demand curve did not shift. You see that, okay? But this is a movement along the demand curve, yes. So what we see here is if less dollars are supplied, the exchange rate will change from 11 to 12. Now, this is where so many learners get it confused. They think then if it goes from 11 to 12, then the rand has appreciated. Actually, the opposite is true. When it goes from 11 to 12, it means that the rand has depreciated because now you need more rands to buy the same US dollar. So the dollar is more powerful because now it can buy more rands. So it has gained power. And the inverse is true. If it goes from 11 to 10, it means that the rand has appreciated because now the dollar can buy less rands, meaning the rand has become stronger. Now, it is confusing to some, and we understand why, because those people are looking at the number. But how you want to think about it is, from 11 to 12, it means that you need more rands to buy $1. And here you need less rands to buy the same dollar. So the rand has become stronger. If it keeps going down until it's 1:1, it means now the rand has gained power over the dollar. If it goes beyond this, it now means the rand is stronger than the dollar. Okay, but basically, this is what we have to deal with. So let us move on and see. Maybe other things. What you see here, this 40, it's $40 million demanded and supplied on a daily basis. This is $30 million demanded and supplied. This is $50 million demanded and supplied. So a shift, sorry, I'm having flu. A shift to the left of the supply curve or a decrease in supply for dollars simply causes the dollar to appreciate over the rand. In other words, the rand weakens. And the opposite is true. As Americans bring their dollar more on the foreign exchange market and say, we want the rand, the rand will gain power. So this happens if more Americans come to South Africa, if Americans invest more in South Africa, if they're buying property in South Africa, anything like that. That shows that there are more dollars that are being supplied. That action will cause the rand to strengthen against the dollar. Okay, if you understand, let's have a look at the questions that we have. Okay, we'll look at the first one. Which supply curve indicates a decrease? Well, this is a giveaway in the supply. Well, it is this one here, S2. So S2 is the supply curve that represents a decrease. See, because this is 40 to 30. So you see, that's a decrease. Number 2, what type of exchange rate system is currently used in South Africa? Well, this is not here, but somehow it's here because South Africa uses this kind of an exchange rate system. So we call this a free-floating exchange rate system where forces of demand and supply are the ones that determine the value of our currency in relation to other currencies. So it's called a free-floating. If the Reserve Bank took part, we would call it a managed. If the Reserve Bank had the rand, pegged, maybe with a commodity like gold, we would call that a fixed exchange rate system. That means if the value of gold goes up, the rand goes up with it. So it can be fixed to a commodity, it can be fixed to another currency. So when that currency goes up, the rand also goes up. But we don't use that system. We use this one. We use forces of demand and supply. So our exchange rate system is a free floating. Then explain the term exchange rate. Well, exchange rate is the rate at which one currency can be traded for another. That's simple. Then state one factor that could have led to an increase in the supply for dollars. So something like this. If dollars would increase in supply, what could cause that? I think I answered this already. More Americans coming to South Africa, more Americans investing in South Africa, more Americans buying property in South Africa, maybe also more South Africans having investments in America that are now paying dividends. So when dividends are being paid to South Africans by American companies, those companies will have to demand the rand and supply the dollar. So all those actions will contribute to an increase, as you see here. That increase will cause the rand to appreciate, as you can see, from 11 to 10. Then use the graph above to explain the effect of the increase. Okay, that's what I'm saying anyways. An increase in supply of dollars will cause the rand to appreciate. So basically, that's what you talk about. Okay, so let's have a look at our answers. So we supply curve, that was S2, as we said. Yes, we use a free-floating exchange rate system. Then explain the term. Yes, it is the rate at which one currency can be traded for another. Then state one factor that could lead. Yeah, I said it. Increase in number of U.S. tourists visiting South Africa. Increase in imports from South Africa. I even gave more than what you see here. Then use the above graph to explain the effect of an increase in supply of dollars on the exchange rate system. Okay, I said it. The US dollar will depreciate, meaning the rand will appreciate. Reason, The supply of dollars increase from S to S1, and the equilibrium point would move from E to E1. The price there is 10, as you see. I don't know why they had said P1, but it's 10. And 10 means you need less rands to buy the same dollar, so the rand is stronger than it was before. Okay, if you don't understand, I have another video that's coming up on the same topic. I'm going to go, well, I'll jump everything else and go straight to another where we have, an exchange rates on a graph, and you have to explain it. Okay, thank you so much. God bless.